Welcome to the Top Business Leaders Show, powered by Rise 25 Media. We feature top founders, executives, and business leaders from all over the world.
All right, welcome everyone. John Corkin here. I'm the host of this show, and every week I get to have great conversations with CEOs, founders, and entrepreneurs of all kinds of companies. Take a look at our archives. We've got some great interviews with the founders of Netflix and Kinko's and Activision Blizzard, LendingTree, YPO, EO, OpenTable, and many more. I'm also the co-founder of Rise 25, where we help connect B2B business owners to their ideal prospects. And this is part of our series in partnership with Scott Anderson from Double Dare Executive Coaching. Thank you to Scott for our introduction to our guest today. His name is Ivan Barratt. He is a real estate investor and property manager and syndicator, specializes in large apartment communities in the Midwest. Since 2015, Ivan has raised nearly $150 million in equity, acquired over 5,000 units. His company is a 3-time Inc. 5,000 listed company, which is really hard to do. So we're going to talk a little bit about how he's done that. Today, he focuses primarily on equity finance, acquisitions, and company strategy. And his company manages about $600 million in syndicated assets, which is not too shabby. And of course, this episode is brought to you by Rise 25 Media, where we help B2B businesses to get clients, referrals, and strategic partnerships with done-for-you podcasts and content marketing. You can go to our website at rise25media.com to learn more about that. All right, Ivan, it's a pleasure to have you here. I'm excited to have you and to gain some great lessons from you. First of all, I love asking anyone who was in real estate at the time about your own personal pandemic, which was the 2008-2009 financial meltdown. Not your personal pandemic, but our entire economy's pandemic. It was such a traumatic time. I was practicing law at the time for a firm that did real estate, and we had so many real estate investors coming to us that were upside down, just overextended, and looking for help on a way out. It was a really harsh time. But you were working for a mentor at the time in real estate and working to work your way up. Tell me a little bit about what that experience was like, what that period of time was like for you.
Sure, John. And before I forget, thank you for having me. I've been looking forward to this for a while now. So I'm glad we finally were able to sync our calendars. And thanks to Scott for introducing us. Scott's been a very meaningful part of my journey, my growth for, I think as long as I've been in EO, maybe 6 years now.
Wow.
I met Scott very, very early on in EO, since I've moved on to YPO, but wouldn't be where I'm at without EO. In short, 2008 for me it's the tale of two cities. It was the worst of times for real estate. At the same time, it actually ended up being, as I reflect back on it all the time, forever altered my DNA as an investor, as an entrepreneur. It was the best of times. I've been working since basically the beginning of 2000, after graduating college, business school, for my mentor. Still, whenever I can corner him and buy him lunch, I still take him out maybe once or twice a year if I can get on his calendar. But I've been working for him for a long time, or 5 years or so when the cracks started forming. Bottom line, a lot of bad things happened. I was a young, arrogant kid with a fancy business school degree that thought I knew everything in real estate, thought it was easy. It was sort of a, hey, you just build it and people come and buy it from you sort of mentality.
And was your mentor, were they doing something similar, buying or building or acquiring multifamily, so apartment buildings?
So my mentor is what we would call a boutique residential developer. So he's done everything from multifamily to land development, very, very experienced, long track record in entitlements or zoning. So buying, acquiring land, figuring out what the highest and best use is for it, and developing a project in hopes that one day you can sell it. So he had all kinds of things going on here in Indianapolis. And for him, he's a very conservative guy. And so he was able to go through that Great Recession relatively unscathed, didn't make a lot of money, but was very good at turning down deals. Me and another guy on his team, young in our 20s, we didn't see a deal that we didn't like, right?
Yeah.
And he was turning down deals left and right. But many of the subdivisions and developments that we had in our pipeline basically went back to the bank in workout.
Wow.
So he didn't make a lot of money, but he didn't lose it either. And he didn't have other people's equity at stake. But
so for you, was it more observing others in the industry that were going under that was so traumatic, since the mentor you were working for, survived relatively unscathed?
Yeah, a lot of observation what happened to other people, losing businesses, losing marriages, losing homes, people that were way out over their skis. Warren Buffett would say, you don't see who's swimming naked till the tide rolls back. Lots of people swimming naked. And, myself included, I had a small percentage, low man on the totem pole of a couple $100 million in development deals that I would be paid out on as they succeeded. And as a early, to mid 20s now, real estate cowboy, I started taking on big private personal loans to finance my lifestyle in my 20s. Because surely my development deals are going to work out. I would just pay it off later.
Right. So and a lot of people signing personal guarantees during that time period that they didn't even realize was in the fine print.
Oh, yeah. So, all these things basically went poof. Everything went off a cliff. All these fancy deals went poof. But, the debt that I had personally was still there. So I'm negative net worth. I'm negative cash flow. I didn't have any assets. I just had real estate that I was betting on the come that I would be able to basically flip, right?
Yeah.
And so I got a very large slice of humble pie. And at the same time, I'm trying to convince my now wife of 12 years. I'm trying to convince her to marry me that I'm a good prospect. And that was one of the lowest points in my career. At the same time, we made the decision. I don't talk about this a lot, but I actually started delivering pizzas 45 minutes from my house so that nobody would recognize me.
Wow.
Just to get some cash coming in the door. We're buying shoes at Walmart. That was the bottom of the bottom. Very humbling experience as I started my company and started to basically crawl out of the hole that I had put myself in.
Wow. Wow.
And that, like I said, that forever altered my DNA. At the time, I saw what large apartment companies were doing, how they were able to manage risk through the sorts of debt that they had, the government mandate to provide affordable housing. So they weren't getting the calls from lenders. Hey, we're calling your loan. And that's what really killed a lot of real estate investors was the lending market for most real estate completely froze.
Yeah.
So the same time I saw this, this going on, it really ended up being, John, the single greatest gift of my entrepreneurial career was
why do you say that
at a young age?
Why do you say that?
Born out of those mistakes I made, were these valuable lessons that I received as far as how to look at real estate, how to value it, pursuing cash flow before pursuing, potential appreciation, capital gains, and upside, and really strengthening my thesis that the most anti-fragile, the best, what we call risk-adjusted return, meaning the lowest amount of risk in real estate, is the acquisition of apartment projects. You still got to execute well. It's not easy, but it's pretty simple. Of all the real estate classes, at least for us, we feel it's the best risk versus reward model that you can pursue.
You think that if you hadn't been through the 08-09 meltdown, that you would have pursued other asset classes?
Oh shit, man! I would have been run over. I mean, if what had happened hadn't happened for another 10 years, my own bubble just would have been bigger when it popped.
Mm-hmm.
Yeah, I would have been the guy with the fancy cars in the driveway, the house on the lake, living
Leveraged.
living high
Yeah.
on the hog, right?
Yeah.
Because I didn't know any better, and I thought this is just how it was done.
Right. Right. You, you- so you end up going out on your own, starting your own company in 2010, which is a fascinating time to start a company in real estate, considering the market, had been going downward for, I guess, a couple of years at that point, and
Yeah.
hadn't quite turned back upwards again. On the other hand, real estate values were down during that period of time. So in retrospect, looking back, was that a good time to start a company? I'm sure a lot of people at the time were like, "You're crazy starting a company, a real estate company now seemed nuts."
Oh yeah, I was told I was crazy. What? I can't believe you're buying in that area, or you're buying real estate right now. Like, what are you thinking? I mean, I remember being at a cocktail party and somebody asking me what I did, and I said I'm in real estate, and they kind of were like, "Ooh, oh, I'm so sorry to hear that." and I don't look in the rearview mirror, John, but if I had a time machine, I would have bought everything I could have gotten my hands on at the time.
Yeah, because the values are just so depressed, I guess, at that time. Yeah,
it was very depressed. Now, money was harder to find at that time, but values were quite depressed.
Yeah, and you also had a lot of personal debt when you started your company. Talk a little bit about how that affected things.
Oh yeah, I mean, I'm lucky. My wife had a pretty good paying job, so she helped take on. We lived in a small house. We didn't have really kids yet, so we were very budget conscious. But we bought a course on the smartest way to pay down debt, and from my earlier real estate transactions and small victories, I would just make these chunks out of the debt. Restructuring it, paying it down as fast as I could. Now today, a lot more debt, but thankfully it's all good debt these days.
Yeah. Now, when you grew up, you were kind of in a family of entrepreneurs. Your dad was a solopreneur, a solo practitioner of law. He also had rental properties. You had an uncle also that was really influential on you. He didn't finish high school, but had bought up gas stations. Talk a little bit about the influence, and your mom also. Talk a little bit about the influence that had on you.
Yes, and another uncle that was a realtor that owned apartments as well. I had two uncles that were entrepreneurs in one way or another. My dad had his own law practice and owned rental properties on the side. Mom, interior designer, marching to the beat of her own drum. So I had these influences about sort of going your own way and blazing your own path versus going to work for someone else. When Rich Dad Poor Dad came out, I think my dad bought me 5 copies of the book, said give some to your friends. So very, very lucky and blessed from that standpoint to have some of those earlier influences, because for me, real estate always made sense. And I always wanted to own a large company. That fire's always been in my belly. But back in time, I really didn't know which way I would go in real estate. Whether at one point I thought I would build like high-end resorts and hotels. Another time I wanted to own all different kinds of real estate, retail, industrial, office. It really was leading up to going through the Great Recession that really crystallized the tremendous value and the minimal amount of risk that one needs to take to build a large portfolio of apartments. And so I really zeroed in on that.
Yeah, and eventually you realize that it's helpful to zero in on one skill set, right? Or one knowledge base. How to do an apartment building. You can do it again and again and again and again.
Yeah, I mean, you took the words right out of my mouth, John. Somewhere in these books behind you is a theme that comes up a lot. It's that a lot of these success stories in business are people that pursued one formula and pursued it vigorously, trying to do one thing really, really well versus trying to do multiple things and being scattered in that way.
Yeah. Talk a little bit about the impact that you mentioned EO earlier and YPO, which you've been a member of. Talk a little bit about the impact that that's had for you being a part of a forum, which I'm sure everyone who listens to this podcast has heard me talk about it before, but it's a small group of peers in other companies you get together with on a monthly basis to hash through your challenges. But talk a little bit the impact that that had for you.
Gosh, so, Think and Grow Rich calls it the mastermind. EO calls it forum. YPO calls it forum. For me, it's been, if we could really pin down some of the top 5 or top 10 things that have had the most impact on my growth as an entrepreneur and as a person, EO is easily in the top 5, if not a little bit higher. So you and I talked a little bit about this. Going into EO, you've got to qualify with $1 million in revenue. And I think it was maybe 6 years ago now, maybe going closer to 7. But I had just gotten over that hump. I wanted to join EO. I heard how great it was. And at the time, I didn't really know how I was going to work any harder. And as I told you, I'm working as hard as I can. I'm only making revenue a little over $1 million a year.
Right. Not profit.
Not anywhere. No, not profit for your audience.
Right. It reminds me of first time I told my mom about EO. I was explaining the qualification criteria and I said, it's $1 million. And she said, you make $1 million? And I was like, no, Mom. Hold on. I don't make $1 million.
But long story short, getting into EO and being around other entrepreneurs. And then also that was when I was first deciding that I needed a coach in my life as a sort of a counterbalance to the forum concept. And that's when I met Scott, who's been an integral part of my my coaching team all these many years. And I've added other coaches since. Those two things, being in that mastermind, being in that forum, and then having coaches in areas where I want improvement from, of course, business, but my marriage, right? Being a good dad, being physically fit, nutrition, being spiritually fit, whatever that means to the individual. All those things, all those areas of my life, I now have a coach in, and I'm in a few different forums or masterminds. Both those things are freaking rocket fuel to my growth as an entrepreneur, which enabled me to grow a larger company, to evolve from being a solopreneur to owning a small business, and then to scaling, with our sights on being a big company.
Yeah. Also talk about, right now, one of the big struggles that businesses are dealing with is attracting good people, putting them in the right seats on the bus, as Jim Collins would say.
Oh, yeah.
What have things been like for you in terms of the labor market and recruiting good people to work for you?
Yeah, I would be lying if I said it's not a little bit tougher than it used to be.
Yeah.
We've certainly had to pay up for the right people. But I figured out something a long time ago, that if you paid a little bit more for someone who, if you pay what somebody thinks they're worth, you're typically going to get somebody who's going to do a better job, stick around for a while, and maybe be a good influence on others who, may come to work alongside. The reason it's not so hard these days for us is because we've been really focused on culture since the beginning. It was a dream of mine early on to have a management company, a real estate company that people would want to work at, versus a lot of traditional property management cultures where, it's a revolving door. People hate what they do, lots of turnover. We found ways to make that more fun and more engaging, and people feel like they're on a team.
Give me some examples of that. What sorts of things do you do in order to make it more fun and engaging and improve the culture?
Well, one of our core values is we're weird, man. We're silly. We don't take ourselves too seriously. So we look for other weird, silly people that don't take themselves too seriously. We're very lucky. We found, it's a little bit old hat now, but I found Slack through EO back in 2014 by hanging out with a tech entrepreneur. Mm-hmm. I'm like, what's this thing you guys are using? And he's like, well, this is how I eliminated, 100 emails a day, was this thing called Slack. And for us, Slack also became this way for people that are spread out across 4 states now. That most of our employees, John, are on site at an apartment community. They're not in a centralized office. So way before COVID and way before we needed it, we found these ways to have fun, give each other shout outs. We call them BAM anniversaries instead of anniversaries, BAM babies. We're all about the BAM fam. Part of our core values are growing a family type organization, no matter how big we get. For us, it's all about employee growth. We say when people grow, BAM grows. And so really, these little tools and tricks are secondary to finding some really key people early on that I overpaid for at the time because I'm a fire ready, then aim entrepreneur. Overpaid for them at the time, but they were able to pick up that proverbial baton, buy into the dream of the culture, and then put their own spin on it, take charge of it. I don't get the credit for it anymore. It's the people at the top who push that down into the organization because they believe in it too, and it's also important to them. For example, we're not going to change our healthcare plan to save a few bucks on the bottom line if it's going to be this huge disruptive thing for all our employees. It's not only about the bottom line for us; it's about how does it affect the management team. We have a lot of investor capital, as you said earlier. We're over 150 million in equity that we're charged with stewarding. The management team is what makes that all work, because apartments are the most management intensive real estate on the planet. That's why we can get the big returns, because we've got the management piece figured out. And such a huge part of that is attracting and keeping good quality, talented people that believe in the cause, believe in the mission, are a little weird, but still work hard and play hard.
Networking is so important, especially as you work your way up the ladder and you grow your business and everything. You're a kid who came from, in your words, a middle-class family. You had a great upbringing, but middle class, and 150 million in, raised funds is pretty phenomenal any way you slice it. So, what have been some of your tips and tricks or resources or the keys behind getting that amount of money and people to trust you?
Well, let's use Jim Collins in the Flywheel to frame this up, right? Mm-hmm. So this is the way we did it. It's much harder in the beginning because we literally raised capital one small investor at a time. Some checks would be bigger than others. But what we focused on as best we could was that client experience, delivering those returns. And what happens is when you deliver on behalf of your client or investor, in my case, and they come back for more and they tell a few friends, the momentum of investors starts building up. And so it's quite simple. So far, we're approaching 500 investors. Some have 15 million with us and some have 50,000 with us, and everything in between. But one thing we've done really well is we've made happy investors, and happy investors tend to come back for more, and they tend to tell their friends. So today, our single greatest source of new investors, even though we advertise and I get on podcasts and we have all these channels for attracting investors, by far the number one channel is current investors at referring us clients. And what's funny about that is, I'm reading Jeff Bezos' book right now, is the collected writings. I didn't know this. Amazon was a word of mouth business in the beginning.
For
Not
investors?
Word straight from Jeff Bezos, man.
For investors or for people purchasing books on Amazon? Or probably
purchasing
both.
For people purchasing.
Yeah.
His customer, my customer is an investor. Right. His customer is buying, but we're buying books on Amazon.
And do you do any little things like, if you're sending a check back to an investor for a successful project, do you do anything special or, for the higher priority investors, or any little tips along those lines?
Oh, I think it's good, to find ways to take care of your investor. I think John Rulin at Giftology's got a really cool thing going. We use him. We definitely like to to keep in contact with our investors, keep a high level of communication. So you're not only calling them when you're looking for more capital.
Yep.
And certainly, some of those larger investors, may get a little bit more VIP status when it comes to events, or maybe they get some tickets to a game or something like that if they're in town.
Right.
But I think one thing that really I want to impress upon any entrepreneurs listening to this, whether you're in real estate or another company, this is agnostic. If you can treat everyone like they're invested with 10 million, even if they just have 50,000, if you can find a way for your team to treat everyone really, really well, it doesn't happen overnight, but it's this magical thing. It's that flywheel and good to great. It's a lot harder to get it started. It takes a while to get it moving, but it's such a big thing that once you get it moving, it starts gaining its own momentum. And if you stick with it long enough, it becomes this thing that's almost unstoppable on its own. And for me as an entrepreneur, that's the real goal, is to create this living, breathing organism that is BAM, that can grow without me. It's almost like my fourth child, John. If I can raise this organism to make its own decisions and grow on its own, then I can have the life I want, the financial freedom I want, without necessarily having to work much harder or even work at all.
Yeah, great advice there. And John Ruhlin, past guest on this show, good friend. He's a great guy. Definitely recommend everyone check out that past episode. All right, we're running a little short on time, but I want to ask you about March of 2020. Of course, that's when the world shuts down from the pandemic. And I love to ask people about where your head was at. What did you experience? What kind of trauma was it like? And also, as you emerged from it, when did you realize that, things were going to be okay?
Yeah. So, to frame that up, so it's actually February for me, and I follow some smart people, and my wife will thank me for this, because I told her in early February, I'm like, hey, I don't know what's going to happen here. This might not be a big deal, but I need you to go to Costco and get like 6 months worth of supplies.
No, that's like the opposite of my marriage. My wife was coming back from Costco with all these supplies. I'm like, what are you doing? Like, you don't need all this stuff. It's like Ebola, I thought it wasn't going to be a big thing.
Yeah. Yeah. So I didn't know at the time, but I said, hey, let's be prepared. I don't want to be like in Costco lines for days. So like, let's just stock up on stuff. And then, it hits, and our model is supposed to work better in a recession, but we didn't know at the time. This is like the greatest correction in recorded history. So I've got my CFO modeling out 70%, 80% of rent collected. Where's our new break even? We run this thing called the break even analysis when we buy a new apartment project. It's like buying a business, right? Where does the business break even? How many people have to be paying rent for it to break even on a monthly basis? Mm-hmm. So we're having him redo all the models. At the same time, I've got 2 assets under contract to buy. Hard money down, meaning if I don't close, I've got to put hard money down at this time. Mm-hmm. And if I don't, I'm not going to be able to do the deal. Or if we get them under contract, and then we don't close, we lose our money. Mm. Hundreds of thousands of dollars, my own personal capital, and my partners. Mm. And so we had to make a pretty big bet. Now, I'm a big reader of Fed policy and financial history. The good, the bad, and the ugly. Naomi Prinz wrote a great book called Collusion here behind me. You've got another one here, The Deficit Myth. So I like reading all the different sides of monetary policy and what happened in different crises. So we made a pretty big bet with our own capital, our investor capital, that what would happen would be the Fed would ease. They would print more money. They were so afraid of 2008 being a deflationary death spiral. And for all intent and purposes, whether you like the Fed or not, they saved our asses in 2008. It could have been much, much worse. Mm-hmm. And they also realized they didn't act fast enough. So for us, we said, okay, they've got the 08 playbook. They don't want 1929 to start all over again. They're going to liquefy everything, which thankfully they did. because we chose to buy those assets. I had a lot of investor phone calls at that time explaining our thesis and why. Luckily, we had some really good investor loyalty. Why they should continue to invest.
They were supportive.
Yeah, when a lot of people were pausing. A lot of people were pausing. A lot of big institutions weren't coming to even look at deals, fly in to look at deals. And so we got this opportunity. We ended up buying some really fantastic assets in 2020.
With these existing apartment buildings, or?
Yeah, all existing.
Okay.
That's typically what we do is we buy existing assets where we it's like buying a business that we know we can improve.
Fix it up. Yeah.
Yeah, we make it a better business than we sell it. Right.
Got it.
In apartments, for all you EBITDA-driven folks out there, in apartments on sale right now, it's anywhere from 17 to 21 times NOI, which is my EBITDA. So the multiples are great.
Wow, amazing.
If you can execute.
Yeah.
And so, we had to stare the abyss in the face, make a pretty big investment decision when the crowd started going the other way, right? We were contrary and said, no, we're buyers. We bought assets, and it worked out very, very well. The renter was pretty much built out. What we were buying only went up in demand. We weren't buying urban apartments, John. We never bought into that demographically. We were buying garden apartments in suburbs with good school districts. Even though people were talking about urbanization prior to COVID, we thought
a lot of talk about that. Yeah.
Yeah, we thought, well, there's going to be a lot of people that are entering a chapter in their life where they're going to start pairing up. They're going to start moving to safer environments with good schools and more space.
A lot of that. I mean, I know in my area, a ton of that. People moving outside of the urban areas over the last 18 months. Yeah,
and so we were buying apartments in there all the way up to and through COVID. So for us, the bets really paid off in a dramatic way to the upside. Our occupancy improved beyond what we ever thought we could hit in apartments. Which we're usually targeting 96% occupancy. We were hitting 98.
Wow.
And we've been raising rents all the way through COVID. It just ended up being a really, really great recession for owning income residential property.
Wow. Well, I want to wrap things up with the question I always ask, which is, I'm a big fan of gratitude. So if you look around at your peers and your contemporaries, others in your industry, however you want to define that, it could be mentors, it could be, forum mates. Who do you respect? Who do you admire that's doing good work these days?
Well, I'm glad I've seen your show and had a little time here to think about it. There's actually like three people that came to mind right away that when I first heard this question on another episode. A guy in Indy named Jerry Collins, his company Flaherty and Collins owns, I think they're around 15,000 apartments now, maybe larger. And he's just been such a warm, transparent, making time for me individual. I would call him a mentor, whether he knows it or not. Been very helpful over the years in figuring out how to scale a larger size company. Just phenomenal human being. One of my early investors, Jimmy, I won't say his last name in case he doesn't want anybody to know, but Jimmy, very smart private equity guy, started investing with me a long time ago. Sometimes the most annoying, in your face, critical investor you could imagine. I mean, his email mannerism, his bedside manner on email is very aggressive. But and sometimes I have to remind my team that we're literally getting tens of thousands of dollars, if not more, in free consulting from Jimmy, because he's given me some of the best advice in continuous improvement and being a better, providing a better customer experience for our investors. So having that constructive criticism, no matter how hard,
squeaky wheels can be painful, but
no matter how hard it might hurt in the moment I get it, I'm very thankful for it. And I'd tell that to his face if he were here. He's a great guy. And then maybe you've come across Don Winter, DLP, phenomenal real estate operator. He's got a really awesome thing going, an awesome mastermind. I can't wait to hang out with him some more. He's doing what I'm doing 3 times the size I am, and he's 36. And
wow,
He is crushing it as a man of faith, as a husband, as a father, and I can't wait to spend some more time with him.
Wow, I love those specific answers. Really cool. Ivan, this has been great. Where can people, I know you have a second fund that you're launching. Where can people go learn more about that or learn more about BAM companies?
Yeah, BAM companies, thebamcompanies.com. We are closing out our second fund. It's a great time to check us out if you're looking to have part of your portfolio in real estate, which is also a good thing if you want to be non-correlated to market swings. Owning real estate in your portfolio, however you go about it, but learn about passive investing if you're not educated out there and you want to know more. We've got some great educational resources. And we are closing out our second fund. So it's a really good time to invest with us. At the end of a fundraise, you can see most of the assets that are in the fund and get a really good idea of what you're buying versus some of the earlier investors. And we think of them as vintages like wine. And our second fund, I think, is going to be a very delicious vintage for the investors. Thebamcompanies.com, John.
Excellent. Ivan, thanks so much.
Thank you for having me.
Thanks for listening to the Top Business Leaders Show, powered by Rise 25. Visit rise25.com to check out more episodes of the show and to learn more about how you can start your own podcast.